Good morning, everyone. Welcome to the very first consensus panel on decentralized finance, or DeFi. My name is Lucas Nuzzi. I am the Director of Technology Research at Digital Asset Research. We are a boutique research firm that provides due diligence, data, and analysis to institutional investors. I'm joined here today by Zach Prince, CEO and co-founder of BlockFi, a service that allows crypto investors to lend and earn interest on their Bitcoin and Ethereum holdings. In terms of usability, I think BlockFi is the closest that we have now to a crypto savings account. And as of April, we had over $50 million worth of consumer deposits. I'm also joined by Nadav Hollander, co-founder and CEO of BlockFi, which is a generalized protocol.
Dharma.
Sorry, Dharma Labs.
First panel of the day.
Yeah. Which is a company building a generalized lending protocol for peer-to-peer lending. And Dharma, we were just talking just now, Dharma just launched, but you guys already have $17 million worth of deposits within the protocol and $7 million worth of loans outstanding. So amazing growth. Last but not least, we have Preston Byrne, a partner at Byrne & Storm, a law firm that helps blockchain, telecom, and cryptocurrency companies with complex cross-border legal issues. Preston has been around for a real long time, often as the voice of reason and rationality and skepticism.
And squirrels the size of cats.
And squirrels.
Known as marmots.
Marmots. So as you can see, we have a very diverse panel here. And we're going to be discussing decentralized finance, or DeFi, which is essentially a movement within Ethereum to bring and build traditional pieces of financial infrastructure on these decentralized and open networks. And DeFi, as this general theme, has seen massive growth so far this year, mostly within the MakerDAO ecosystem. There's now over $450 million locked in DeFi applications, which, you know, it's impressive on its own, but if you contextualize it, $300 million within MakerDAO made in loans. So terrific growth for the ecosystem. So to kick off this conversation, how about we start with you, Nadav? What would you say is the biggest value proposition of DeFi and the problems that's trying to solve?
Yeah, so I would really kind of, when I think about DeFi and the problems that it solves, I like to think about it in kind of like three levels of fidelity, right? Like from kind of the micro to the macro. You know, on the micro, like on the individual transactional basis, the value prop of DeFi is basically just like saving costs by removing intermediaries. And you know, when you're talking about over-collateralized loans, it's probably like the easiest model to think of. It's like, whereas in the past you would have to have some sort of trusted party custodying collateral and some sort of legal framework around that loan agreement in order to enable people to seize on that collateral, and in turn a whole variety of different costs incurred onto the transaction. In DeFi you use smart contracts, and so therefore you remove an intermediary, you remove a lot of the legal cruft, and in turn you know, the transaction becomes cheaper. So that's kind of just like on the micro level. I think that the basic idea is just like using smart contracts to remove trusted intermediaries and thereby make transactions cheaper. And then you can kind of zoom out like one more level of fidelity and kind of think about it in terms of like a more kind of systemic fidelity of like what happens when you have a whole ecosystem where by default all of these sort of API endpoints for interacting with different financial products are open and permissionless to build upon. And you can already see all sorts of fascinating experiments and kind of early offshoots of this today in the DeFi ecosystem, where people are kind of like composing together different products and sort of linking them together and building all sorts of wonderful open source tooling for analyzing the industry and so on and so forth. I think that's really, really powerful. I think if you lower the barriers to entry of building financial services, that's going to create a much more competitive financial system, and thereby kind of lower costs even further and increase access. And then finally, and this is probably my most like kind of harebrained thought about this, is that like on the really like macro level, I think that DeFi is kind of a movement about building a financial system that isn't tightly coupled to our political systems. And in a world where our political systems are kind of getting freakier and freakier by the day, I think it's really important that the systems that kind of support our day-to-day transacting and saving and so on and so forth remain separate. So
Fascinating, yeah.
that's the way I think about it.
Zach, you've pursued a completely different approach to lending on crypto. So was that derived from research from you guys looking at decentralized custody and smart contracts for collateralization, and then deciding to go the other route, or was the plan to offer a centralized service from the get-go?
Yeah, I mean, it was certainly one part risk management. Is my mic working in the back? Yep. Yeah, so it's certainly one part of a function of risk management. You know, we started BlockFi in 2017, and at the time, smart contract custody wasn't something that was particularly developed. But it also came a bit from our experience in the fintech industry, where we knew one of the things that was going to be really important for BlockFi was to diversify our product suite and to offer fiat on and off ramps and create products that look and feel like what consumers are used to seeing in the traditional world. So today we have a savings account that yields 6% on Bitcoin and Ether, and we have the ability to borrow USD from BlockFi secured by the value in your crypto assets at a low cost. And one of the big differences, I think, between DeFi, at least as it stands today, and a company like BlockFi is that we KYC every single one of our customers. We do that because we have regulatory requirements that are put on us from the federal and state level here in the US. And on the one hand, that gives us the ability to know who our customers are and be able to cross-sell different products to them. It also gives us the ability to connect with the traditional banking system, but it comes at the expense of user experience a little bit. And so I think there's really this interplay between coming into DeFi, where no one really needs to know who you are, you just have your MetaMask address, you can transact from anywhere in the world, versus a centralized system where you need to onboard, provide your identification, and disclose the transactions that you're making. And you're starting to see a bit of a kind of inverse pricing in the market that you wouldn't necessarily expect when you think about DeFi versus a more centralized company. So right now on MakerDAO, the price to borrow DAI, which is their stable coin secured by your crypto, is 19.5%, which is a lot higher than it costs to borrow US dollars from a company like BlockFi. And so I think there's become a little bit of a DeFi premium in terms of the pricing, and it'll be interesting to see over time how that changes and evolves.
Yeah. One of the things, and you mentioned over-collateralization. I think over-collateralization has been the kind of hello world of crypto lending, with things like 50% LTV ratios, 60% sometimes on Maker. What are the approaches from, I guess, both of you guys to increase capital efficiency and maybe decrease the LTV ratio? Because from someone looking from traditional, markets, a mortgage, you put down 20% as a payment. Is that an interface problem? Is that a due diligence problem? How are you developing that efficiency?
Yeah, sure. I mean, we certainly lend crypto to certain counterparties without requiring over-collateralization today. Mm-hmm. In order to do that, you need to know who's borrowing from you. You need to be able to take a view on the financial health of that business and the level of counterparty risk that you're incurring. And in the absence of knowing who your customer is, I think this over-collateralization requirement will probably persist, but you are seeing it trend downwards on some of the newer decentralized platforms like Dharma and like DYDX, where I think the collateralization ratio to borrow is maybe 110 or 115 maximum versus Maker, where it's 150%.
Yeah.
Yeah, I mean, I think that a way you can think about it is like there's like the scaled version of it and the kind of more bespoke version of how you do under collateralized or kind of like one-to-one collateralized loans. Zach kind of gave you a good picture of how it's done in a bespoke manner generally with a business that you may be able to analyze. I think that we haven't really seen it happen. We haven't really seen like credit-based lending happen much on a scaled basis in the crypto ecosystem yet. And most experiments in that regard have been like, trash heaps of failure. Yeah. But I think it's possible, and I think it's really it's like the traditional fintech industry quite regularly does unsecured loans on the basis of credit scores. Like there's lots of very built out infrastructure for this sort of stuff. And so I think it's just a matter of kind of like the industry maturing a bit and starting to essentially build notions of creditworthiness for users. And then I think competition will naturally drive the industry to a place where we're kind of driving collateralization levels lower and lower and lower over time. So I think it's inevitable.
Yeah, and there's some clear trade-offs in terms of how decentralized your offering is. You know, as a generalized lending protocol, Dharma doesn't do, you know, due diligence on whoever's using the protocol. It's open, it's public. You just create an account and you can use it. And there are definitely trade-offs between following, you know, Zach's approach of a centralized custodian. You guys have partnered with Gemini to offer your services versus a generalized lending protocol, which is more peer-to-peer.
True. I mean, I think that if you want to create like a fully decentralized like notion of creditworthiness, like that's hard.
Yeah.
That's really, really hard. There's a lot of unsolved problems there in terms of like, you know, doing civil protection and things like that. But at the end of the day, if you go to Dharma.io, like it is a product run by a centralized operator, namely us. And we kind of facilitate lending using the underlying protocol. And so nothing necessarily prevents us from embedding notions of creditworthiness into the product. And in turn sort of enabling under-collateralized loans or one-to-one collateralized loans.
Yeah, and I think there's a point where you need to introduce some form of governance to enact changes to the protocol, to look at the ways that things are going to evolve. And I want to bring Preston in. So you see a lot of DeFi applications that want to adopt this tokenized DAO model, this decentralized autonomous organization model, as a result of this necessity of having clarity and governance and investing resources on making the platform better. What are your thoughts on the trade-offs between, you know, pursuing that approach of a tokenized DAO, having a generalized DAO, or not having a DAO at all?
Well, is this working? No, it's not working. It's on. Yes, there we go. Well, I think it's very silly. The idea of using these tokenized DAOs. Just by way of further background, it says I'm an attorney, but I also founded one of the first, if not the first, permission blockchain startup back in the day. So as a consequence, I've heard a lot of stuff about DAOs for a very long time, coming from people who've been around for a very long time, and not a lot gets past me. So when you see, for example, a company saying, well, we're going to have a decentralized lending protocol, and we're going to have a governance system, and because we have a governance and voting mechanism, you know, not naming names, but you know, there is one prominent system with many millions of dollars locked up in it that has a governance mechanism, and they say, well, because we have this, it's going to fix all of the problems with the decentralized finance system, because we can just adapt it as we like and change things. And we've got this 10 lines of code, and it's not going to be too hard. Finance is hard. It's a lot harder than these developers who are very, very long on brains, but very, very short on experience, give it credit for. When we built an application for Deutsche Bank in 2015, it was a corporate bond, and we extracted all of the economically relevant events from the bond, and then we expressed those in code, and then you push go, and you put a UI on it, and hey presto, you've got a bond. That was 50,000 lines of code, right? You're not going to be doing that on public Ethereum, and you're not going to have the capability to do it on public Ethereum, and you're certainly not going to get a committee of non-financial professionals to make prudent decisions about how you should adjust, for example, interest rates. So with MakerDAO, by way of example, we've seen interest rates going up to 20%. They've described that product for the longest time as a loan, but it's not really a loan. If you talk to someone in banking, you'd say, well, that's a revolving credit facility with a term of 1 week. And if you ask the people who are putting the money into the scheme, is that really what you intended to do? And you ask the people who created it, is that what you intended to create? I think they'd say, no, we didn't. So with these things, it's obviously nice to have some governance involved. I think there are some AML implications from a regulatory perspective in terms of operating an unlicensed money transmission business. But it doesn't fix the fact that this stuff is actually a lot harder than it looks. And so what we'll see, I think, is companies that take a slower approach and don't, for example, take on balance sheet risk, Dharma, for example, or are actually run by financial professionals are going to last a lot longer in the space than the projects which, the stable coins, so to speak, which try to rush to production in order to go and get VC dollars and grow and scale and all this sort of stuff. That's not how finance works. That's not how banking works.
Yeah, one of the things that I worry about that's lost on some of the decentralized platforms is the concept of what's good for the user. So you can wave your hands and create these governance structures, but if you forget who the core initial user of the platform is, then you can find yourself in a scenario where interest rates go really, really high because we're trying to stabilize something else over here, and it's a bad experience for that core user that deposited the Ether onto your platform in the first place. And one of the advantages that centralized companies have is that we can very quickly iterate and launch new products. So at BlockFi, we have 2 products today. We'll have a third, which is largely driven by feedback that we've heard from our existing clients, and we'll provide new portfolio management functions to them in the 3rd quarter of this year. And then we'll be launching a credit card where you can earn crypto rewards instead of airline miles or cash back in the first half of next year. And doing those things requires knowing who our customers are, complying with regulations, and also coming to the problem set with a user-first and customer experience-first mindset.
Yeah, that's fascinating. So, Nadav, like to counter this, you see, centralized companies like Coinbase and certainly others leveraging protocols for staking, for example, now, and using public infrastructure built around staking and loans, or at least there's an interest on that end. You started your career at Coinbase as an engineer. From your perspective, how long will it take until we have entities with massive amounts of liquidity to leverage something that is kind of out in the open, like the Dharma protocol for peer-to-peer lending and things of that nature? Is that required for DeFi without intermediaries to succeed?
Define, what do you mean by institutions with lots and lots of liquidity? Like
just crypto, the traditional crypto on-ramp.
Okay. Okay.
Like Coinbase, for example.
I would hope that Coinbase becomes more involved with building products that hook into kind of novel new decentralized financial infrastructure. That would certainly be in our interest. I find it much more likely that first-party products that are built entirely on the protocol's value props and that kind of try to differentiate themselves as being these novel new financial products. I think that those are let's put it this way, I think it's much more likely that an upstart will essentially grow to become one of those new sort of crypto incumbents, and that a existing crypto incumbent will come in and sort of direct their fire hose at the existing decentralized financial infrastructure. Because at the end of the day, it's hard to build on this stuff. It's really, really new. It's a really, really limited set of expertise with a really limited talent pool that can do it. And so I find it less likely that the narrative is going to be like, oh, the Fidelity or Coinbase or Gemini or whoever built this product that hooks directly into the underlying infrastructure.
Yeah, and I think part of it is the use case for lending at this point, and I think there's very sophisticated players that are leveraging DeFi applications, namely MakerDAO, for leverage, right? Because it just works. We are at a point where hopefully there's this belief that the bottom is in and people just want leverage, and they're willing to use this level of sophistication with decentralized finance applications to attain that. Do you think we're going to continue to pull this thread on leverage for a while before we start on peer-to-peer lending, or are you guys building Dharma for a generalized purpose? Or
yeah, so I think leverage will continue to probably be the main use case for at least 12 to 18 months or so. Primarily because it's kind of like what you were saying earlier. Like right now, the way all these systems are architected is that they rely on over-collateralization. Yeah. And that inherently sort of limits your borrower user base to people that already have crypto. And in particular, if you already have crypto, then there's kind of only really 2 reasons why you would want to borrow. it's either because you want to take that crypto and then go and buy more crypto, or because like you want USD or something like that as working capital for your day-to-day life to pay bills, yada yada, et cetera. And in particular, if you now zoom in on DeFi, it's not yet easy to use stable coins to do things like pay your bills and do normal things with it. So inherently, there's a lot of sort of exogenous factors that make it so that I'm skeptical that we will be moving past leverage as the primary borrower use case in DeFi in the coming 12 to 18 months. With that being said, our ambitions are wholeheartedly bigger than that. Absolutely. I think that it will start with leverage, and then it will start to crack into adjacent sort of slightly more mainstream use cases, and slowly, bit by bit, we'll slowly get to a point where really any sort of unsecured borrowing use case will be supported by the DeFi ecosystem.
Yeah, fascinating. So Zach, from your perspective, how is BlockFi being used on the borrower side? Is it leverage as well as you see in DeFi applications today?
Yeah, so you have to be really careful to always contextualize what type of borrowing you're talking about, because borrowing USD secured by crypto versus borrowing crypto are two completely different use cases. When BlockFi is lending USD, we actually see the leverage use case very infrequently. It's more of a wealth management tool where for loan sizes below $25,000, for example, it's frequently being used as a debt refinance mechanism. So someone has higher cost credit card or student loan debt, and they use the financing from BlockFi, which is at a lower cost than that other debt, to repay that debt and then carry a lower cost debt load. Larger US dollar loan sizes, it's a wealth management tool. So people are using the capital to invest in other productive assets. It could be purchasing investment property, it could be a private equity fund, it could be stocks and bonds. And then on the crypto lending side of things, the equation is a bit flipped. So on the USD lending side, retail is our borrower, and institutional capital is who's funding the loans that we're making. On the crypto lending side of things, retail is our depositor, and they're earning interest on their crypto holdings in crypto. And then we're lending the crypto to institutional borrowers. And so we talked earlier, it came up that there had been peer-to-peer crypto lending platforms before. And what happened with those, there were a few like BTC Pop, BTC Jam, and you had retail lenders lending Bitcoin to retail borrowers, and every time the Bitcoin price shot up like it's doing right now, you would have a massive amount of defaults because as a retail individual, you probably shouldn't be borrowing in an asset that's as volatile as crypto unless you really know what you're doing and you're basically a professional trader. So we have retail depositors on the crypto side and exclusively institutional borrowers.
Yeah, I think the compounding of crypto for someone that already uses a centralized custodian because they're an institutional investor, it's a very compelling argument. And I think we're just scratching the surface in terms of financial products built around this idea of debt. How far do you think we are from a dividend-paying, Bitcoin instrument?
I think we have it today.
Yeah.
Yeah, I mean, if you're a BlockFi client, you earn 6% a year paid in Bitcoin, and it's paid out every month. I think you'll see. I think this theme of earning crypto rewards or crypto interest is one that will continue for a while. If you can swap airline miles or normal cash back, whether it's with companies like Lolly or others, and instead earn in crypto in a way that you would have traditionally earned dollars, you have some kind of built-in leverage there, which is if crypto prices continue to go up, then your effective cash back is much higher than 1 or 2 or 3 or 4%. So I think that trend will be one that we see more products built around in the future, and I see continuing.
Yeah. So switching gears a little bit, Preston, this stuff is difficult. Debt, I think, is already a concept that a lot of people that are not even aware of crypto struggle to understand. Do you think DeFi, do you think regulators are ready to understand what's happening within the DeFi ecosystem? Do they have the tools and resources to, pursue regulation from a sensitive approach? Or do you think, we're going to come to a situation where there is regulation put out that doesn't really show fundamental understanding of the technology?
I think the regulators understand this stuff perfectly well. I think they understand how dangerous it is from a debt perspective. A lot of what we hear about DeFi is, go leverage long on cryptocurrency, right? So let's say you've got a 300% collateralized loan, and you go leverage long on some crypto, and you don't have any cash. You borrow it, and you go spend whatever you're going to spend it on, crypto, whatever else, and then there's a crash of some kind, and you get liquidated, and you have a disposal, and that disposal is taxable, and you don't have the cash to satisfy your obligations to the IRS or whatever revenue authority you have. The downside risk of doing all of this is very substantial, and I think a lot of the people who have now got money locked up in MakerDAO, they're saying, hold on a second, there's a withdrawal penalty, and what happens if I have to pay taxes? And people are starting to realize that you can't escape the old problems. Just because you have something which is decentralized does not mean suddenly it becomes prudent to take out very large amounts of debt, which may give rise to tax liabilities in order just to get some cash now, and you don't have to pay the tax man, because crypto will always go up and always go to the moon. Well, that's not true. We know that's not true. So that, I think, is one risk. And I think if people start to get burned, that'll really get the regulators' attention. Looking at FinCEN's guidance from last week, it's the US Financial Crimes Enforcement Network. They put out some updated guidance, I think for the first time in about 6 or 7 years, about how anti-money laundering regulation will apply to things like dApps, DeFi dApps presumably are included in that, ICOs, Bitcoin ATMs. It's very specific guidance. And there's a risk that these products that are being built are money transmission products in some cases, present company excluded, because we had a chat about that, but some of them are very clearly money transmission. And there's a regulatory intervention risk. So you could have people who have their funds locked up in these contracts. The schemes then get shut down, and then it takes them years to get their funding out. So, if they get it out at all. So there are all these risks around DeFi that haven't really been properly addressed. It's very easy to look at it and say, well, it's decentralized, it's on Ethereum, and it's more efficient, and how wonderful is this? But in there's risk. It's percolating, and the bigger the schemes get, the bigger the risk becomes. And because, frankly, in crypto, it's a new industry, there are fewer of us, and it doesn't really pay. I can state from experience, it doesn't pay to be the skeptic in the room. Nobody funds the skeptic in the room. The skeptic is there as an opinion providing an opinion that no one wants to hear. But the risks are there, and I don't think people are really appreciating them or mitigating them in the way that they should.
Yeah, I think one of the scary things from regulators and even institutional investors when they look at the current state of DeFi is this idea that gets tossed around of superfluid collateral, right? So this idea that there's an IOU that I hold, and I use this as a collateral for something else, and basically rehypothecation, which was one of the culprits of the 2008 financial crisis. But there's also value in having a system where maybe derivatives can be priced more efficiently, where rehypothecation can be tracked more efficiently. So from your perspective, Nadav, are you guys looking into that? Are there people already building rehypothecation tools on top of something like Dharma?
To my knowledge, no. But as a broader sort of meta point, I absolutely think that permissionless innovation is and always has been a double-edged sword, where you get wonderful, incredible things created that never could have existed previously, or never would have been conceptualized previously, and solve problems that weren't addressed previously. But you also, it's the wild, wild west, right? You're going to have people build complex financial derivatives that they are not well equipped to be designing. You're going to be seeing the system kind of go through booms and busts of kind of risk and being over-leveraged, under-leveraged, and so on and so forth. And I think, I don't think it's the sort of thing that we should just toss our hands up in the air and say okay, it's just going to happen. But if I could kind of provide one sort of note in favor of the DeFi ecosystem's fundamental architecture, is that it's transparent by default. And that's really, really powerful. And the example that I like to give is that if you look at the run up to 2008, it wasn't like any like snarky blogger on the internet could have like easily written a blog post saying like, hey, look, this system is crazy right now, and be really, really easily able to point to like the transparent data that that's the case. Whereas right now, you know, like if Preston has issues with the MakerDAO system, he gets a stage to talk about it, and there's a lot of transparent data that he can reference to sort of, you know, back that case. And that, I think, is what's really crucially important about this ecosystem, and that provides at least some sort of feedback loop from the outside that will at least help curtail these sort of violent booms and busts that are likely to happen.
Yeah. On the point of superfluid collateral, I don't know about you guys, but speaking as an attorney, I like my collateral thoroughly encumbered. and in a place where I can find it and get my hands on it. And it's interesting to see, you know, it's interesting to think about how you could move collateral around more easily and keep track of the obligations more easily so that, for example, it's not going to be, you're not going to, you know, violate a negative pledge clause, and you can move all kinds of assets around. But I think we've seen when, you know, when that happens in you know, big boy finance, you wind up with 2008. And so that is something which very much I'm skeptical about.
Yeah. Yeah, the counterpoint is that in terms of pricing, instead of having, you know, this crazy 2,000-page contract, you have a crazy 1,000-line code contract.
Well, but 2,000-line contracts are there so lawyers can prosper and charge lots of money to draft them. So I support those wholeheartedly.
So we're approaching our time here. So how can people learn more about what you guys are doing and any closing statements that you might have?
Yeah, we're pretty easy to find. So blockfi.com is our website. You can follow me on Twitter at BlockFiZach. We have a booth here in the exhibit hall on the 3rd floor. You just walk in, turn left, you'll see us on the right-hand side. Would love to see you there.
Yeah, so if any of you guys want to really give DeFi a try, we really like to think of our product as probably being the easiest way to experience what a DeFi product is like. And so you can use Dharma in order to either earn interest on your existing crypto or your crypto dollars in the form of DAI and soon USD coin. And we'd love to kind of have you guys kick the tires on our platform and give it a shot.
I usually don't charge for the first phone call, so. But you know, it kind of does what it says on the tin. I'm a lawyer, so if you got a problem, give me a ring.
All right. Thank you guys for listening.
Thank you.